if you haven't bought any gold, if you've been following me all these years and now gold's at 3,000 and you're thinking, okay, finally, Peter, you've convinced me I'm going to buy some gold. Don't do it. Buy the mining stocks instead. This is how you turn back the clock, because the mining stocks are not priced for $3,000 gold. They're not even priced for $2,000 gold. So it's like buying gold at 2,000, except it's at 3,000. So even though you missed the boat, right, you can get back on. Now, you didn't miss it in the sense that I believe gold is going higher. I think gold's going to 4,000, 5,000. You'll make a lot more money, I think, if you buy the mining stocks now, because the move from 3,000 to 4,000, that's about a 33% move. I think gold stocks could go up 5 or 10x on that move.
Gold stocks have been on a tear lately, though Wall Street has begun to question whether the good times will continue. The price of gold has risen 16.6% since the start of the year. Eclipsing those gains have been shares of gold miners themselves. Barrick Gold has risen 21% in 2025, while Newmont and Agnico Eagle mines have done even better, surging 29% and 35% respectively. Gold stocks rallied today since gold prices directly impact gold miners' top and bottom lines. Notably, most of today's top-performing gold stocks have delivered strong operational performances lately and are fortifying their balance sheets. Prominent economist Peter Schiff emphasizes that despite gold's rise from $2,000 to $3,000, gold mining stocks have seen little interest from retail investors. With central banks buying metal, not stocks, and silver still undervalued, he sees a major upside in mining equities. Despite trade war turmoil, Peter Schiff notes that gold has remained strong, unlike oil, boosting margins for gold miners. He expects huge second-quarter profits for miners due to high gold prices and low energy costs. While gold mining stocks play a role in the gold price, they are much more than that. In the past, gold mining companies indulged in wanton value destruction. During gold's last bull market, which ended in 2011, mining companies borrowed heavily to fund new developments and extract gold from low-quality mines. After the gold price dropped, they were forced to announce write-downs. As far as the market is concerned, Schiff warns that U.S. tariff policies are accelerating the global shift away from the dollar and treasuries. Contrary to expert predictions, the dollar has dropped and interest rates have spiked, signs that mainstream analysts still misunderstand key global shifts. The dollar index rose 0.11% to 102.88 after early losses, while the yuan strengthened as China's central bank instructed major state banks to limit U.S. dollar purchases. The dollar was down 1.01% versus the yuan offshore to 7.349 yuan, after reaching an all-time high at 7.4292. Now we present the clips of Peter Schiff's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
What's happened as a result of the trade war is not only has gold held near record highs, one of the only assets not to sell off, but oil prices collapsed. They actually went below $60 a barrel, although they closed back above it today. We had a pretty good key reversal. So I think the low is in for oil, but still, oil has come down considerably relative to gold. And that is going to be great for Q2 earnings for the gold mining companies. They're already going to have great earnings in Q1, but I think they're going to blow the doors off in Q2 because I think gold is going to hang out near 3,100 or higher, and oil is going to be slow to recover. So in the meantime, the profits are going to be huge for these gold mining companies. And, you know, I've been advocating for a long time that people buy physical gold, right? And since I started recommending physical gold, it was under $300 an ounce. It's now over 3,000. So you've got a 10x. But while gold itself has gone up 10x, most gold stocks aren't even close to those returns. There are a few, but the vast majority have barely moved. You know, especially in the last year, as gold has gone from 2,000 to 3,000, you've seen no interest really in the gold mining sector. And the main reason for that is because the public hasn't even been interested in gold. It's central banks that have been buying gold as they've been de-dollarizing. And based on what Trump has just done, I think foreign governments are more likely to want to get rid of their dollars and their treasuries than they were before. We've made it clear that we want these trade deficits gone. We've also made it clear that we're not willing to defend the rest of the world. We want to make them pay for our defense. Well, what they were getting, one of the things they were getting for subsidizing our trade deficits and loaning us money and supplying us with goods is that we defended them in case they got into trouble. Well, if we're not going to do that anymore and they've got to pay for their own defense, then why are they propping up our economy? Again, Donald Trump kept saying that the world was screwing us over and taking advantage of us. He's got it backwards. It's America that's been taking advantage of the world because we rely on the world to live beyond our means. But the world can only finance that by living beneath its means. Well, that's going to change. It's going to change because the dollar is going to go way down. And so we're going to consume less and the rest of the world is going to consume more. And that's how our trade deficits go away as our standard of living declines. But in the meantime, the world is getting rid of dollars in advance of a major depreciation. One of the things that all the experts got wrong, they all thought the dollar would rise if we imposed tariffs. Instead, it tanked. The same way they thought that interest rates would fall if the economy weakened, instead they surged. So the experts still don't understand what's going on. But that's the reason that these gold stocks are still so cheap. All last year, as gold rose 50%, typical Americans were selling their gold. And they were selling gold stocks. In fact, this year, in the first quarter, GDX is an index of gold mining stocks. And only one day in Q1 were there inflows. Every other day of the quarter, there were net outflows, meaning as gold was going up basically every day, retail investors were selling their gold stocks every day. This is unprecedented. Normally, when you're in a gold bull market, and this is a powerful bull market, normally the stocks lead the metal because stocks are forward-looking and investors get excited. And gold has been dragging the stocks. The stocks always sell off every time gold has a small correction because everybody thinks the market's topped out. In fact, I've done several interviews this week about gold, and people keep saying, well, is it too late to buy? Is it a crowded trade? It's not crowded at all. How can it be crowded if no one's bought it? The only buyers are the central banks. That's why the stocks are still so cheap, because central banks don't buy gold stocks. They buy gold. That's also why silver is cheap.
In his analysis, Peter Schiff calls the announcement of reciprocal tariffs a major policy blunder, saying they caused a sharp spike in bond yields and market turmoil. He believes Trump's pause on tariffs was a face-saving retreat after realizing the economic damage. He states trade deficits are a symptom, not the cause, of structural economic weakness. With several $1 trillion in the market value of U.S. stocks wiped away in the days since April 2nd, Liberation Day, forecasts of an outright global recession have grown. J.P. Morgan has raised the chances of a global recession to 60% by the year's end, from 40% if Trump carries out the full plan he laid out last week. By imposing tariffs, Trump risks making the U.S. even less competitive, hurting Americans through higher costs and worsening stagflation. The measures announced by Trump on April 2nd will take the average tax rate on U.S. imports from 2% all the way up to about 22%. Plugging that increase into the Fed's model shows a U.S. gross domestic product reduction of almost 3% and a boost to inflation of about 1.5%. This toxic combination, which economists call stagflation, will likely play out over 2 to 3 years. Let's get back to the interview.
Now, I thought the announcement on Liberation Day of these so-called reciprocal tariffs, and I say so-called because we really didn't reciprocate for anything. They were reciprocal in name only, but I thought it was a major policy blunder. And when stock and bond markets in particular, because last night the bond market really started to crash and the yield on the 10-year Treasury got just above 4.5%, and the 30-year yield peaked above 5%. I think the president and his advisors tried to find a way to surrender, but make it appear as if they were declaring victory. So that's really what Trump did today by pausing the reciprocal tariffs. And the markets had a big relief rally because he undid a lot of the damage that he caused by launching a war that America can't win. Now, yes, not all the tariffs are gone. The 10% baseline tariffs remain. The fentanyl supposedly fentanyl-related tariffs on Mexico and Canada remain. The 25% auto tariffs remain. And Trump is talking about other tariffs. But I think those reciprocal tariffs are not just paused. I think they're gone. I doubt that they're going to be resurrected, because now that Trump has gotten a taste of the damage that they do, I don't think he has the stomach to bring them back. And also, while Trump might claim that he's got better leverage now, I think that if he had any leverage, he's lost it, because I think he's shown just how vulnerable the U.S. is to a trade war when we did so much damage, within a week of launching it. See, the problem is the president thinks that we've got all the cards. We don't, because we depend on the world. We depend on the world to supply us with the goods that we can't produce, and we depend on the world to lend us the savings that we don't have. Trump is complaining about our record trade deficits, and they hit record highs when he was president the first time, and they got even worse under Biden. He is correct to point to the trade deficits, but the trade deficits are not the problem. They are a symptom of the problem. The reason we have these horrific trade deficits is because as a nation, we spend too much and save too little. And so because we don't save enough, we don't make the capital investments to build up the factories and the supply chains and the infrastructure. And so because of that, we have to rely on all those factories abroad for the goods that we can't produce. And because we spend more than we produce, we need to get those goods. For a problem that we created, we actually don't do anything about solving the problem. So while I admire Trump's goal, he is not going to come close to achieving it. In fact, the tariffs that he's already imposed are going to backfire, and they're going to make the American economy even less competitive than it was before the tariffs. And the tariffs are paid by Americans. They're not going to be paid by our trading partners. There is no external revenue. It's all internal. And this tax hike on average Americans is going to weigh down an already weak economy. And so we're going to have a bigger dose of stagflation.
With gold prices rising significantly this year and in a clear uptrend amid the tariff and trade wars, 2025 could be a big year for most of these gold mining companies. Therefore, buying some gold stocks now amid the stock market's volatility could be a smart bet. As gold shines brighter and confidence in the dollar wanes, will investors finally turn to mining stocks? And will policymakers recognize the long-term risks before it's too late? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.